How about at the end of the day, do you do anything? Like, I'm really fascinated by rituals and things like that.
So I think it's really important to be ethical and make sure you're paying them well above.
Innovators is that when you look at a property perspective, it's a future home.
Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Good afternoon, good evening, good day, wherever you are, and welcome to the Rask Live program. I'm actually just dealing with an unruly turkey outside my window, so that's why I'm a little bit late. It seems to be going a bit nuts today, so hopefully it's not too bad. I'll try and dial down my mic, but I can see Adam already said it's the best day in a while. I wasn't 100% sure what he was talking about, and he says you should know not to check your portfolio daily. But I hope you're all well and welcome. It's very sunny here in Melbourne. Sorry to everyone in Perth. Navar, good to see you in the chat, my friend. Navar, real quick, I was thinking about you today, Navar being the founder of Navexa. You did a core and satellite video, right? Like a video where you could, where you explained that someone could track their core and their satellite portfolio together inside Navexa, which is, for those of you that aren't familiar, this is how we track the fake news portfolio, which we are going to talk about today. This is the technology here, and there is a link in the YouTube description to join Navexa. If you haven't already, works with virtually any broker, at least that's just what I know. No sound, says Percy. I sound working for me. Yeah, it seems okay. Maybe it's a bit of a tired Steve. Maybe it's a bit of a mute situation or audio down on the keyboard or something like that. Navar, if you could just chuck your core and satellite video in the chat, that would be great. There's a link to it. That would be handy for anyone that is wanting to track their actual portfolio. So you can have multiple portfolios being tracked. You could track the actual portfolio and then another portfolio, like how someone could do that. Because one of the really important things for people is that if you do, so say you build a core portfolio of ETFs and you're quite happy with that. But then you're like, I'm getting pretty good at this and I want to improve the way I think about investing in individual companies, but I also need a way to know that if my satellites are actually working or not, or if I should just stick with core investing. The easiest way to do that is to use a tool like Navexa to track your portfolio, but sometimes people get a bit confused, like, how do I track my core portfolio? How do I track my satellite portfolio, and so on? In any case, welcome to Rask Invest Live. Every now and again, meeting every Thursday, we catch up here on YouTube. You may be watching on LinkedIn or Facebook or something like that. That's okay too. Most of the banter happens over on YouTube, which is just on the Rask YouTube channel. And every week we talk about different things. Like today being the first week of every month, I get a lot of questions about this. The first Thursday of every month is all about the fake news portfolio, the portfolio that we're going to build together over the first year and then set it free into the wild. We're going to build this portfolio. We've got $1 million fake Navexa dollars that Navar has kindly lent to me. He said he's got a lot of them, and he said we could have 1 million of them. So we've got $1 million fake Navexa dollars, and we've started in the first month. We just put it in the AAA cash ETF, just for safekeeping. And now we've started to deploy some capital. So we put some in WiseTech, Wesfarmers, the bond ETF, IAF, and we picked a US company as well. We put Home Depot in there, for those of you that are familiar. Home Depot already up 12% for us, even beating the mighty WiseTech. Look at that, 1 month returns. We're basically the next Warren Buffett. Wouldn't that be nice? But one thing you should all know is that's not related to this portfolio is I have COVID at the moment. So if my voice goes a bit funny or if I go a bit patchy, it's solely because I've got COVID. But rest assured, I do have my Yo Pro here in the corner. If you can see me, it's a high protein mango yogurt. I don't know if actually know if that would help. I just thought, well, why not? But I do have COVID. Everything's fine. So if my voice goes a bit croaky, I'm okay. And we are going to talk about a few different companies that folks have sent in. There were a lot of submissions in the Rask community, like a lot of different submissions, and some of them were fun. Some of them would take me a bit more time to get through. So there's heaps of ideas here that I can table for next month and so on. So thank you to everyone who sent through some ideas. Some people who also gave feedback to other investors on some of the ideas. We're going to go through these live. I don't like to do too much prep on these things in advance because I want to make sure that we can kind of go through them together. But I've kind of whittled them down into a few different interesting names. So today we're going to talk about XRF Scientific, which is a tiny little Australian industrials company, which is this one here. $230 million market cap. I'll zoom in a bit so we can all see. And we'll talk about this business, what it does, why it's quite interesting, and how it makes money. Talk about the FANG ETF. There were some changes with this recently, as pointed out in the Rask community. So we'll talk about this ETF in some detail. We'll also talk about some gold ETFs. We'll talk about Ingham's chicken. It's not actually the chicken that you get at KFC or whatever. We will talk about the company itself. Ingham, a place up in Queensland. Does anyone, just as a bit of not a show of hands, because I probably wouldn't be able to see your hands unless you did a hand emoji in the chat. Has anyone been to Ingham? I have. Has anyone been to Ingham? That's what I would say. Okay, so keep going through these. Have you already subscribed? That's wonderful. If not, why not? Jump on the subscribe button on YouTube there. It's free and you get notified whenever we go live. We do actually do more than just the Rask Invest live show. So our YouTube channel has, I think, every single day you can now get something on the Rask YouTube channel. So our new retirement podcast, for example, just launched a few days ago. Not a few days ago, a few weeks ago. Really popular with Drew and James. Already super popular on YouTube in particular. You can get short form content. You can tune into the property podcast. We just recently did this podcast with Tom Patrick, just talking about commercial property investing, and it's really popular with some retirees. And we just have so much. Australian finance podcast, business shows, you name it, it's all there. So check it out. Okay, so Joe, you have been to Ingham. That's good to know. Okay, so Graham, you said, have you ever considered hedging portfolios using BBOS, Bear, SNAS, etc., when the market is above a moving average, for example? So Graham, two questions in one almost there. The first one is, well, actually, I'll read this first as a disclaimer, then I'll get to that, mate. So general financial advice warning. Anything that I do, anything that I say, maybe even gestures that I make on the show are strictly general in nature. I don't know anyone's personal needs, goals, or objectives. So none of the information that you hear on the Rask Invest live show or any Rask podcast or any podcast in Australia for that matter can give you personal financial advice. Therefore, you must always consider your own needs, goals, or objectives, or if you don't know what those are and how information may impact you, go and see a financial planner before you act on the information. I'm getting a lot of questions from people in our community or people who follow us on social media. They say, hey, Owen, I just heard from someone on Facebook that looks like it's your account. They've been messaging me and asking me to invest $5,000 in this strategy and join them on WhatsApp. That's complete bullshit. That is a scam. We will never DM you. We will never approach you for investment. We will never, ever do that. The scammers have got so sophisticated now in copying us that I got a message the other day, which was my own voice talking back through the phone, words that I've never said. So just please keep your wits about you. Even though we are licensed to give financial advice in Australia. A lot of what you see online is not. And even if it does seem like it's relevant to you, it is not personalized financial advice. So if you're in any way unsure, go and find a licensed financial planner. Our financial planning page, if you go down to the bottom, it tells you how to find a financial planner as well as to verify them on the ASIC website. So you can actually go, it has instructions here on how to check if they're actually a financial advisor and they're actually licensed. My rules for anyone on the interwebs is pretty simple. If they ask you to go to WhatsApp, if they ask you to go to Telegram, Discord, or any of those apps, if they ask you to download an app to communicate with them, they're full of shit. It is a scam. Do not trust it. All right. That is 100%. You can take that to the bank. It is a crock. Now, the second thing is that you got to take full responsibility for your own investment decisions. It's your money, not anyone else's. So do the proper checks and never trust anything that you get online unless you can verify them on the ASIC website. I want to be very clear about all this because it's been running rampant with AI and all these things. It's crazy. So don't trust anything. Now that I've done my very stern warning, I want to go back to Graham's comment about have you ever considered hedging portfolios using BBOS, Bear, SNAS, etc., when the market is above a moving average, for example? Okay, so first things first, I'll tackle the second bit first, is that I do not use moving averages or any type of technical analysis, charting, etc., Graham, because I don't mean offenses. I actually think it's complete gibberish. And I believe that a lot of that stuff is just designed to suck people into an investment strategy, a technical trading strategy, not an investing strategy. That's just my own personal opinion, mate. Now, I know everyone's different and everyone has, it's fair enough, but I don't not in any way, a technical analysis, like I do not use that in any way. In all the professional investors that I've spoken to throughout the world, don't use it. Now, that's just me and that's just the way I think about things. Now, would I actually use this ETF? The answer is yes, but I wouldn't use it for a moving average reason. I wouldn't use it for a technical analyst reason. If you look at an ETF like this, and for people that are unfamiliar with what these types of ETFs do, this one in particular, you can see the black line here. I believe that shows you, I don't know what index that is showing you, the ASX 200. So that black line is the ASX 200, and the orange line is the chart plotting the ETF. Notice how the ETF is going backwards most of the time. It's only during like COVID crash where it went spiked up. So what it does is it goes in exactly the opposite direction, or not exactly, but it goes in the opposite direction of the stock market. So if you think about this, you could buy this ETF when the market is falling and this thing would go up. And the way it does this is through derivatives contracts. However, if you looked really closely at this ETF, you will notice that it doesn't actually always move as you'd expect. And that's because some people get confused with these ETFs. They think they should always own a little bit of these ETFs for protection, which is a really bad idea. Because if you do that, you can see that you'll eventually just keep losing and losing and losing. This ETF, in my opinion, this strong bear fund, the strong one, not just the regular one, is the one that most people would choose because it's basically 2 times leverage, so 2 times the impact, whereas the traditional just single bear one is 1 times. But the key thing is most of the time stock markets go up. Most of the time. They should be, if you think about moving averages, most of the time the stock market should be near the top of the moving average. So if you think about it, if you always had this on, you would be always losing money. And there would be very rare occasions, like for example, this one time back in COVID when it actually worked. But in the meantime, you've lost all the money. So these are actually I would say, very dangerous ETFs unless you use them very precisely at the right moments. So yes, you would consider them. No, they're not something you should own all the time, and they should be used sparingly. That's just my general gist of this whole dynamic. I have never owned them. I know some investors, professional investors, who continue to hold them, even though just because they're spooked about the market. And I don't think that that's worked for them. But that's just my 2 cents, general, obviously, in nature. I on this ETFs, I think they have a place. Just be very careful about how investors are using them. That would be my broad general advice on that. Now, back to the task at hand. It was a great question, by the way. So I know people wanted us to add, Percy in particular, I believe you wanted us to add Costco to the portfolio. I'd love to know why. Um, so Tarwin says, Percy, there was vigorous debate on Costco during the last live session. Home Depot won. I'm still going to Costco after this session, regardless. Yes. Jane says she's visited Ingham. Okay, so the reason that I think that there was no real reason that we didn't include Costco. I think it was just a we just chose Home Depot over it, but we're definitely able to include those types of companies if you want. I think it's a great business. I'm going to drop something in the chat as we get into it. Is this chat here, this link here? I've just popped it in the chat now. It's the /philosophy page. So on the Rask website, and this might help Graham. This might help you understand my opinion of why investing works and why trading strategies don't work, other than just that academic data and the industry data, which suggests they don't work. But this is how we invest at Rask, and it kind of guides everyone in our community of how to build an investment strategy, think about why investing works, why the stock market exists, so on and so forth. But if you scroll down this page, it explains why we select the ETFs we do for the core of our portfolio. And then it explains why we invest in the companies that we do in the satellite component of our portfolio. So you can see them all here. And g'day, Matthew. Good to see you on the chat, mate. So you can see, for example, here, the things that we're looking for in the companies we buy must have a strong and durable competitive advantage, must have good management team that is aligned, talented, and transparent. The businesses must be within our circle of competence. The business must operate in a structurally growing and increasingly important sector, and the shares must be reasonably valued. Now, I'm going to come back to this because as we put companies into our portfolio, a few things to keep in mind. If you look here, what we talk about a lot on the show is the core and satellite approach to investing. We talk about, I'm just going to have a drink of my water here. Sorry about that. If you look at the core and the satellite approach, which we talk about a lot on the Rask network, it's about having this core portfolio of ETFs, and then around the outside, we have what we call satellites, which is the smaller, higher quality companies, the thematic ETFs, maybe even some crazy things like crypto or whatever else, like trading strategies. This overall mix of the way we build wealth helps people understand how you can have a rock solid portfolio in the middle that is proven to work over long periods of time. But you can also use those other trading strategies, the individual stocks, these types of things, as you go through investing and you want to be curious about it. But the key thing is here, we could also rename the core and satellite approach. Don't waste your time on crap. Because what we are effectively giving ourselves permission to do with this strategy is saying, we're going to pick the boring stuff for our core portfolio, the ETFs, the Aussie shares, the US shares. We're going to do that in a cost efficient way. We're going to do it in a tax efficient way. We're going to do all of that other stuff. And then around the outside is where we'll have fun. But when we go around the outside, we're not going to waste our time buying quote unquote cheap stocks. Like one of the things that people often say to me is, "Hey, Owen, just heard of this company. And by the way, it's really cheap." There's a reason that cheap stock investing doesn't work. I mean, there are many reasons, but there have been many studies that show that only over the long term, the only types of stocks you want to own in a core and satellite portfolio strategy like this is the best companies. Now, I know that sounds really simple, if you have a core and satellite approach, only own the best companies. Isn't that what everyone's trying to do? A lot of people don't do that. A lot of people kind of settle for companies that they think are gonna do something. Oh, it's going to create a mine in WA. Oh, you know, blockchain is gonna revolutionize the world. Or this company's new product is gonna catch on with surgeons, and their consumers are gonna love this one. None of that stuff really works. What does work is repeatable business models that time and time again, like Costco, keep on winning, and you can verify the business. And there was a study done. This one was from Boston Consulting Group as well, I think, and it basically shows the best performing companies in the world over 25 years. And you can see that really the companies that beat the average are companies that do something exceptionally different, but they start in a core product that is really, well understood and well trodden. There are only two companies that are in this bucket, by the way, from Australia. Only two companies. One is Pro Medicus and the other one was CSL. So these are the only two companies that Boston Consulting Group could find in this world beaters kind of area. And what they found is that the companies that win consistently are companies that are value creators for society. They create value for their customers and for the world. That's the first thing I want you to keep in mind. But what another study from Boston Consulting Group also found that if you took the top 25% of companies in the world, and I've referenced this chart a lot, is that it's only after 5 years that the actual benefit of owning that company kicks in. So if we look here, I've shared this 20, 30 times on Rask Lives over the years. I'll share it another 20 or 30 times, I'm sure, is that only after 5 years does the actual growth of a business and its profit margins start to explain why a stock goes up. So some people who, for example, say, oh, it's a cheap stock, right? They'll say, oh, it's a cheap stock, therefore I should buy it. What they're effectively saying is, I'm going to try and buy it because it's got a low price earnings ratio. But as you can see, if you continue to be a long-term investor, at 10 years, that virtually means nothing. For the best companies, it doesn't matter if you buy it at a cheap price if you hold it for long enough. And so this all comes back to what we're doing here today is we're going to look at some companies that fit into this part of our strategy, right? But as I said, don't waste your time on companies that haven't proven themselves, that don't have a competitive advantage, that don't have great management teams, that don't have long growth runways, because ultimately they most likely they won't win. You might get lucky and be able to own a stock for a year or two, but the reality is that's not a repeatable long-term wealth creating strategy. What is a long-term wealth creating strategy by the looks of all the data is owning companies that have great products, great services, good business models, and are in an industry that keeps growing. Now, I know everyone just heard the chickens outside, and they definitely did enter the conversation. The turkey knows that Xmas is around the corner. Yeah, I'm not allowed to do that this year. I'm not allowed to do that this year. Percy, you did come up with a very good point, which is that Charlie Munger did sit on the board of Costco. So I'm going to jump into the Ticker terminal. Ticker is not a sponsor or anyway affiliated with the Rask Invest live show, unlike Navexo and Pocketsmith and Superguide, who we're going to hear from in months to come, Perla, all these wonderful partners, Rask Invest. Ticker is just a tool that I like to use. People ask me how much do you spend on this? I think it's about $20 a month. So because I have this, I very rarely log into my brokerage account. I almost never do because I don't need to, because I've got all the best data right here in front of me. And it's only about $20 a month. So you're right that Charlie Munger was on the board of directors for Costco. And I think we talked about this previously when we talked about the business, but it actually makes a lot of its money. I don't know if we've got segments in here for this company. No, we don't. It actually makes a lot of its money from memberships. So, that's $65 a year that you pay to shop at Costco. It can basically use that membership fee that you pay to run its business and then virtually sell all of the products at cost or very close to. So that's basically how it runs its business and how it's been able to grow for so long. It builds insane loyalty, and that gives it more volume, as in more sales. They call that inventory turns. So the turnover of the products on the shelves is just like a rapid velocity, and that's what Charlie Munger used to talk about when he said that he bought shares of Costco. He talked about that and how the types of customers that Costco attracts and how it keeps on reinventing itself. But the business is really exceptional. So if everyone is in agreement, we could add some of this to the portfolio. We just didn't do it a little while ago. So okay, so $30 a month, $30 a month USD. Okay, so there you go. Matthew, you say, is Ticker similar to Seeking Alpha? Seeking Alpha, I'm not as familiar with it now as I used to be, but Seeking Alpha used to be more about insights and tools and technology, about like articles and that sort of stuff. Ticker is purely about like fundamental company data. So I'm sure like technical investors and that and chartists and that sort of stuff use it. For example, if you like click on like Tesla, you'll be able to see like charting tools and that sort of stuff. But it's mainly for people that just are like me that want to understand businesses, want to do comparisons. If I'm doing a valuation, I still do all the data myself. I go into the annual reports myself. I don't rely on any third party. It's a slow and tedious process, but that's how you earn the insights. So cool. Okay, so I'll continue on. Percy is saying how much? Well, let's get through this session, Percy. We've got how much cash do we have in, or how much fake money do we have in this Navexa account? Where am I? So we have $1 million portfolio, and I think we have 845,000 Navexa dollars that we could still allocate. So we've still got a lot of capital, a lot of dry powder that we could put to work. But let's start, now that we have the rules of the game down pat, let's jump into Ingham or ING. When this was first tabled on the Rask community, I was like, oh, I love ING, the bank. I used to own shares in ING. So I was like, okay, yeah, I could do that. So it's ING Group, I think is how you do it. So I used to own shares in this one right here, ING being the orange bank that many people are familiar with. But that wasn't what we were talking about. We're talking about Inghams, the Australian business. So let's have a look at it. Now, I would like to know, and I'll put the question back to you all, is if we think about a business like Inghams, and we'll get the description here, Inghams Group Limited, together with its subsidiaries, produces and sells chicken and turkey products in Australia and New Zealand. It offers chicken and turkey products and stock feeds for poultry, pigs, and dairy industries. The company was founded in 1918 and is based in North Ryde, Australia. Let's go to the website. Now, I want to ask you all a question. If you were to start researching a company like Inghams, and let's say, you've done all the usual steps, you've kind of got a gist of what the business does, where would you go to start researching this business? That's the first question. Where would you go to start researching? Second question is, what metrics would you look for? So what financial metrics would you be looking at to study a company like Ingham? So we've got, where would you go for your information to get a kind of nuts and bolts? How do I actually understand what this business does? That's the first one. Second one is, what metrics would you look at to study a company like Inghams? While you're doing that, I'll have a look here. That guy looks familiar. This looks a bit like Ingham up in Queensland, to be honest. Looks like they're all enjoying a bowl of something. The chickens outside wouldn't like us researching this business, that's for sure. Yeah, okay. So you get a sense. We kind of know what it does. If we can go to the About Us page, we might find some information here. It's founded as a family business in 1918 in New South Wales. Father's death in 1953. The sons expanded the business in Australia and New Zealand. The present operations date back to the 1960s. It entered into supply arrangements with major retail and quick service restaurants. It subsequently entered into the production of turkey and stock feed. Today, Inghams employs 8,200 people and continues to build on Ingham's proud history of quality and customer service. supplying major retailers, QSR operators, food service distributors. Inghams Group also holds strong market positions in Australian turkey, Australian stock feed, and New Zealand dairy industries. So we can see a few different things here. Dean says it supplies to KFC. Interesting. Okay, so that's good news. What else is in here? So the network, let's click on that. So if we scroll down, look at this. Where is this? New Zealand. Okay. So here we can see it's all of its operations. So this kind of gives us a quote unquote bird's eye view of the business. And we can see that what type of facilities do they have? So breeding farms, broiler farming, don't know what that means, hatcheries, primary processing, further processing, distribution. So a massive network of different types of operations that it's running. Now I'll just come back to the comments here in the chat. 100-year-old business, says Percy, is very good. Yeah, yeah. And Dean says supply KFC. Percy, you say that has the stock price gone up over time? Free cash flow over 5 to 10 years, growing revenues, gross margins, interest coverage, etc. So broilers are meat birds, says Phil. Thank you, my friend. That actually does fill it in for me. I'm not a. I've got to admit, I'm not a big chicken eater. So there's that. But I could lay claim to be maybe the only vegetarian who may have slaughtered their own chickens and turkeys in the last year. So there's that. Graham, you said Ingham's price target cut 7.9% to $2.90 a share by Goldman Sachs. Thank you, Graham. That's great. Okay, so one of the things you can do here, and this might interest you actually, Graham, is if you go into estimates inside Ticker Terminal, you can actually see. So if we go, for example, say revenue, for example, if we click on that, we can plot that over time. You can actually see where it's got A up the top here. I'll try and zoom in a bit. That's the actual numbers. But then if you go into E territory, that's the expected numbers. And this is based on analyst forecasts for the company. So I don't often just read into, like, I like to see what analysts think, but that's about it. Like, it's not, if we go back to the way I like to invest for 5 or 10 years, what an analyst thinks about next year is not that important to me. What's more important is the business itself. But if we look further out into the future, we can see that according to the other analysts, we can see that it's like 7% growth at most over the forecast period. You can actually see as I hover over the different years, you can see how many analysts have contributed to this average. So 10 there, 10 there, 9 there, 2 there. Only one analyst has data going out to 2029, which is a pretty long way. Most analysts only forecast out 2 years, which to me is probably not enough. Not for a growth company. Not to say that this is a growth company. I'll tell you what I would look at initially. So the first thing I would do if I don't understand what a company does is I would go to its website, just as we have done here. And the About Us page is a great place to start. Another way you could do it is you just go to Wikipedia. Although Wikipedia can be contributed to by almost anyone, we can actually get a good sense of the origin story. You can get a sense of what the business does, how it makes money, where it started, why it started, these types of things. And so you can see here that Inghams is a supplier, producer of poultry and fodder across Australia and New Zealand, and it goes through the history of the business. Another thing that I really like to do, if we go back here and we go to filings, and we go up the top here, we go to full year, that should do. If we go into something like this here, which is the full year report, so if I click on this, the other thing, some of you would have heard me say this, is I go to something called the segment report. So the segment report, page 74, if you've ever been really overwhelmed when you look at a company on the stock market and you go, I can't really understand what exactly they do, in this part of the annual report, otherwise known as a 10K if you're looking at a US company, the segment information tells you the different business units and how they make money. So if we go down to page 74, we're at page 15. We've got a long way to go. Zoom out a bit. We're almost there. Okay, page 74. Here we go. So here we can see on this, it's in the notes to the financial statement. We can see that the business is broken up primarily into two segments, and it's broken up by Australia and New Zealand. It also says something here which is quite interesting. Two customers generated in excess of 10% of group revenue. So that's basically saying two customers have a lot of control over the sales of Inghams. But it could be also that Inghams has a lot of control over them because that Inghams might be the biggest. And so here we can see that the sale of poultry is huge compared to the money that they make from feed. So even though they might talk about feed a lot, clearly it's all about poultry. It's not about the feed and the stock feed and that sort of stuff. And if we scroll down, we can see EBITDA. We can see for different geographies, and we can see what the total company made. We can see depreciation on different assets and equipment and that sort of stuff. Here we can get down. We can see that there's a big finance cost in here. This is normally for loans or debt the company has. And we can see the profit before tax. So I prefer to look at a business like this rather than jump straight into the income statement and the profit and loss statement, because it actually shows you by different products or services. And you could do this same thing with Costco, for example, and see that they would probably have memberships and products. Costco would also probably have maybe online sales and things like that. Coles and Woolworths, the two Inghams customers, Graham, potentially it might also be something like KFC or something like that, McDonald's. Tarwani says, is chicken more of a commodity though? Coles and Woolies hold the pricing power. Graham with a H, can you expand on what you meant by this comment? Inghams wouldn't be on my radar for investing. I'd love to know what you mean. Other Graham said, Inghams has a history of missing earnings, including the most recent times. Company website says Tarwin Market Index for overview and financials, which they get from Morningstar. It's a good resource, absolutely. Thomas, you've said Australia's bird flu outbreak has claimed the lives of 2 million chickens, but experts fear the worst is yet to come. That's from ABC. Obviously a huge thing in recent times is, all those birds dying from, viruses, basically. But I just wanted to introduce you to this concept of looking in the segment report. Every company in its annual report has to share that, by the way. So if we now jump back into Ticker, another thing that I wanted to do is I have a suspicion, and I wanted to show you, I wanted to answer the question that I asked you, is which numbers and which metrics would I look at in something like this? So one of the first things that we would look at for a company like this, it's a more mature business, is we would look at the, if we go up into the balance sheet here, we scroll down, I would look at the total debt balance, and I would look at the total debt balance over time. So we can see the total debt through time, it increased around COVID, and you can see that it's slightly come down through time. One thing we can do instead of total debt is we can match that against the cash that it has, because it might have a lot of cash. It doesn't. In this case, you can see that it doesn't have a lot of cash. Net cash or net debt is just a figure that shows you like cash minus debt or debt minus cash, depending on how you look at it. And this is basically saying it's got a way more debt than it does in cash. Now, you might be saying, well, why is this important? Some companies can have a lot of debt, especially mature companies. Like Apple has a lot of debt. I think it's got over $100 billion of debt, but it's also got more in cash, so it can sustain it. But the thing that I think about a lot is, how does the debt get there, and why did the debt get there? So a lot of people don't always think about this in respect of like, why is the debt there? And typically in businesses that have gone from from private ownership to public ownership, if it's owned by a private equity company or if it's owned by some sort of investment company, what they do is they strip out all the cash and they replace it with debt. So they pocket the cash and they put debt in, and then they sell it. So it's kind of like, if you go and buy a business just down the street, you go and buy the cafe, and you find out that all the equipment inside the cafe, all the coffee machines, the tables, the chairs, the cutlery, all of that's on finance. They don't actually own any of that stuff. What are you actually getting? If you think about it, you probably wouldn't want that versus, say, the cafe that owns the coffee machine, that owns the tables and the chairs and all that sort of stuff. But in investment markets, we seem to just accept that, oh, it doesn't really matter if it's got debt. Someone's meanwhile is made off like a bank robber with all the cash. And so now another thing that we got, okay, it's got a bit of debt. Let's continue on. Another thing that I would look at, and I think it was Percy that said this before. Another thing that I would look at is something called the free cash flow number, which is just here. So free cash flow, if I get rid of the debt, if I just go back here and I'll just remove that 1 second. If I look here, I can see the free cash flow in the last 5 years has been pretty good, to be honest. 287 million, 279 million, 256 million. Yeah, it's declining, but it's still pretty solid. A lot of companies don't have free cash flow. For those of you that don't know, free cash flow is a metric that compares the cash that comes in the door versus what has to be paid to maintain the business in cash terms. So not in profit terms, which is like, it gets into a whole thing called accrual accounting, but just in simple cash terms. And a lot of analysts use free cash flow, including myself, to do valuations. So this is a really important metric. And you can see in times gone by, it didn't have any free cash flow. And there could be quite a few reasons for this. I'm actually just going to quickly Google the stock price and go to the max time. So it looks like it hit the stock market in 2016 at a price of, say, nearly $3. So 2016, it would have been around about here. And you can see the financials have improved over time. That's pretty good, but it's got a lot of debt now. So that's probably not a great thing. So ultimately, already what we know, it's got some major customers that it has to fulfill. It's got FYO, and you can type the page number you want in the PDF if you click the current page number at the top of the toolbar. Thank you, my friend. So just up here, right? Now that's quite interesting. I'll tell you another little hack that I use to get around an annual report really quickly. So I use a Mac. So I press Command F. I think it's Control F that you could use on your PC or whatever. And you can't see it because it's a pop-up, but I search for something called comprehensive in a PDF, which is comprehensive income. And I can just press that a few times and it takes me down to the income statement. So I don't need to search for it. I just press comprehensive in the finding bar and it takes me straight there after a few taps on the old enter on the keyboard. Okay, so far this is not really, like, I don't like to see a lot of debt. I like to see cash flow going up over time. So there's a few things going against this business. In terms of ratios, a few of you did mention, I think maybe Tarwin, some of the things that I like to see are a high return on capital. So you might hear some professional fund managers talk about this. Return on capital, return on invested capital, ROIC. It goes by many different names. But basically what this compares is a company's ability to take whatever money it has, whether it's debt, so the proceeds of debt, or cash, and then put that in the business and get a return. That's what it's calculating. A lot of people use return on equity. So you've probably heard ROE, like return on equity, if you've been a stock investor for long enough. That's not a good metric to use. The reason why companies will tell you to focus on ROE, like banks and that sort of stuff, banks are probably just a slightly different case, but the reason why is if you look here, right, it looks really, really, really good. Oh, look, our return on equity is 48%. That's really high. But then you look at return on capital, it's 11%. Why? Because return on equity doesn't show you the impact of debt. So you want to make sure that you are using the impact of debt, and return on capital is the best way to do that. So that's the key thing. Now, so I would be looking at this and saying return on capital, not that high. And then I would be looking at, if it's got a lot of debt, I would want to know how well does it cover its debt. So one of the things that we can use to calculate how well does it cover its debt would be we compare the cash flow to the interest payments. And so you can see that expressed a few different ways. So you've got earnings before interest and tax, earnings before interest, tax, and depreciation. So this figure here, EBITDA, Charlie Munger called this bullshit earnings, but we'll move past that. So if we go to the income statement, so what we're effectively, we won't go here actually, we'll go to the segment report. There we go. So if we go to the segment report here, we can see that they reported $471 million for the business in 2024. What this metric is comparing is that figure versus the interest that they pay on their debt. And you can see that over time, even though they've got more debt, they've kind of maintained this buffer of 5 times. This would be like saying my mortgage cost me 20 grand a year, but I earn $100,000 after tax. Or this is before tax, so it'd be before tax. Therefore, I can pay my mortgage. That's effectively what we're saying here. And a business like this that is quite mature, that's a pretty good number. That's pretty high. So what else is there to look at? Tuny, good afternoon. ROE versus ROIC. Do you feel the same when it comes to market cap versus enterprise value? The answer is I don't really like that metric. Enterprise value versus market cap. I don't really. Let me just back this up. So enterprise value is market cap. For those people that don't know, let's give ourselves a new little sheet here. I've got to make a move. So if we take the market capitalization of a company, let's say we've got ING and we just, such that Inghams is $1 billion. That's a nice round figure. So this is 1.07. What we're effectively saying is this is market cap, right? Market cap, that's the value of all the shares, just for familiar. Now what we do is we take the amount of debt, which I think was 1.7 billion, like this. So just off the top of my head, 1.7 billion, that's the debt, all right? And then what we do is we subtract the cash. So if the cash is, say, this little bit up the top here, I'll just quickly jump back in and just have a look at how much cash there was. Cash. So there was 110,000 up here, we can see. We can see, where was the debt? We can see the debt was 460,000. There's a lot of lease liabilities in there. So it's not true debt, but it's still something to keep in mind. So we can see that there's a minus a cash amount. And what we're saying is, if we get the black or something like this, here we go. What we're saying is this figure here is the enterprise value. So some people like to compare the profit metrics. So like price earnings ratio, the PE ratio that people quote all the time, that compares effectively the market cap to the profits. Another one that people like to do is they compare the EV figure to the earnings down here. It might be like EBITDA. I think you're kind of onto something there, Tuny, that, yeah, I mean, if I had to make a choice, I would, of course, use enterprise value rather than market cap. But I don't use that a lot, to be frank. When we do valuation models, I like to compare to EV and to market cap as a common sense. So what I mean by that is, like, I use a discounted cash flow analysis to do my valuations, and that gives me an actual dollar figure on the valuation of a company. But then, say if it was like, I think Graham said before, $2.90 was Goldman Sachs valuation. Say, for example, my valuation was $2.90. I then kind of check that against the enterprise value and the market cap to make sure it makes sense. Like, it's a bit of a common sense. Does this actually make sense? So I know that doesn't really answer your question, but I hope that makes sense. Graham, you say they have a decent dividend yield, so that must be servicing their debt easily. Yeah, so it looks like they've got a very decent dividend yield, Graham. And because they have positive cash flow, it looks like they can both pay the debt and pay a decent dividend. So if we go into the, where is it? The cash flow, where are we? So if we see here, Graham, what we can see is this is on the cash flow statement, probably the most important for any business, but you can see here they made $418,000 of cash just from the business activities, right? Then they paid out $164,000 for investing, what are classified as investing activities. So you can see they made a small acquisition of $6.6 million. They got some government grants. You can see that they made some purchases of some property. So this could be anything. It could be like even equipment. It could be anything. Capital expenditure. This might be actually where they put their equipment and whatever, like factory equipment and whatever. So when we compare free cash flow, typically what we are basically looking at, it's not perfect, but we take this and then we subtract this and that gives us free cash flow. That's the money that then is available for the business to pay back its debts, to issue dividends, to do that sort of stuff. So here we can see it's paid back some lease payments on the principal component, the interest component. We can see that it's paid some dividends here. So if we took 420 million minus 160, it leaves plenty to cover these other things. But ultimately, even with paying the dividend, Graham, you can see that this year in particular, they actually went backwards. So they might keep paying a dividend and they might just be break even. But that doesn't necessarily mean the business is reinvesting enough for future growth. Like, we have to make an assessment as individual investors. Oh, okay, they spent $86 million on capital expenditure. So that could be like improving things. They spent $76 million on property purchases, which could mean not necessarily just land. It could mean anything. Is that enough? Should they be spending more? The year before, they didn't spend that at all. Should they be spending more? So we have to make an assessment, because if they're not spending enough, then that means the dividend will likely be cut in the future because their business is sustainable. So that's kind of where that idea is from. Now, just first glance, I don't actually think this business is unhealthy. But if we go back into ticker and we go down to more ratios, another really good sign so this is probably the most important sign of a company that's really healthy, is a nice juicy, no pun intended, a nice juicy return on capital figure, and also a net profit margin. So if we go down to net profit margin, which is this one right here, you can see it's got a profit margin of 3%. Now, I know I've wasted a lot of time on Inghams today, but if we go and now I want to do something, this is where things will get interesting. If you go to our philosophy page and you read through this, you'll read through it and you'll understand, okay, that all sounds great. Yep, no worries. One of the things that we bring in at Rask, which not many people talk about, is an idea called the best expressions principle. And this is like us, say, we start here and we start researching Inghams. And we go, okay, yep, got the chickens outside. I kind of understand what it means to invest in a chicken company. Oh, yep, they've got some debt. That's okay. We'll move past that. Oh, yep, it's got a high dividend yield. Okay, we're here. We're ready to go. Right before we get to this point at Rask, we ask ourselves, hold on a second. Is this actually a good idea, or is there something else that we should be doing? And so at this point in time, we say, got good dividend, looks like a reasonable business. It's not great, but it's okay. Now we ask ourselves, well, why are we going to buy this thing? And the answer might be, well, I like the dividend. So let's have a look at the dividend. Let's have a quick look at the dividend. According to the overlords at Google Finance, 6 to 7%. But as we've just determined, it may not be, even if it's sustainable, not grow into the future. So is there a better way to get a 6% dividend? How about if we use something like VHY, the Vanguard Dividend ETF? This includes 70 dividend paying stocks. So you got 70 rather than one. And we go to portfolio data. We can see here, we can get a 5% dividend yield, or thereabouts. Not a 6.9% dividend yield, but a 5% dividend yield. But there's 66 different stocks paying us that dividend. And by the way, it looks like the companies are growing at around about 5% a year. That's probably the better expression of the trade. So this illustrates how you can go through this research process. You can get there and you go, you know what? If I wanted income, I may as well just do this. Now this is only just a really quick analysis. It's not like normally I'd spend weeks on a company, but you get a sense of like that best expression principle coming in. Now, if I go back, typically what I like to see is I don't like to see businesses with net margins of 3%. That's pretty gross. It's not really the type of business that I want to buy. Some people who are more cigar butt investors, like buying the cheap stocks, quote unquote, who have a shorter term time horizon, may be interested. But now I want to just introduce you to another way to think about the way you invest. Let's say you go through this process and you think, okay, it's a good company, but are there other companies that are involved in chicken? If I think chicken's a really important thing, are there other companies? Well, let's just have a very quick look at these two businesses. Wait for it to load. There we go. So for those of you that don't know, Yum Brands is the owner of the KFC franchise globally, and Collins Foods, which is got the symbols KFC in it, in its ticker symbol. These Collins Foods is the Australian franchisor of KFCs. Yum is the brand owner globally. It's kind of like how in Australia we have Coca-Cola Amatil, which has the rights to Australia and Indonesia, but the actual company is owned by the Coca-Cola company in New York. So this is how the businesses kind of come together. Now, what we can see, if we look at the profit margins, you can see a very stark difference. You can see Inghams, which sells the chicken, has a profit margin of 3%. The Australian KFC business has a profit margin of 5%. And the actual brand owner of KFC has a profit margin of 22%. So then if we go back and we look at let's do a quick little thing here. If we look at ING and then we go something like this, and then we'll get, can I do more than one at a time? Yeah, there we go. And now we look at the companies over time. So obviously the Yum Brands business has been going for a lot longer, but if we just go like 5 years, we can start to see that Yum Brands has performed very well over 5 years, or reasonably so. Inghams hasn't done that well. It's probably paid a better dividend. Collins Foods has gone slightly backwards. But basically, so this chart isn't perfect because it doesn't plot everything. But basically, the longer you invest, the more important those, profitability metrics become. So while it may make sense to buy a cheaper stock that pays a good dividend for the meantime, what's really important is that you find the companies that have the better economics, the higher return on capital, the better profit margins, the longer term growth runways. These are the businesses that you want to own for longer. And so I think if you're looking at a business, just know where it sits in your portfolio. Inghams might be for me after I've done some more research. It may be a company that I buy, but I wouldn't buy it with a long-term perspective because it just doesn't have the profit margins. It's got a lot of debt. But Collins Foods or Yum Brands might be the business that I bet on for chicken. And I hope that makes sense. So Graham, you said to my question before, Graham with a H, you said, I wouldn't touch Inghams because in the most recent report, net profit was down, earnings per share was down, net profit margin was down, cash flow is similar to 3 years ago. Fair enough. So that's all fair enough. Graham, you said, Owen, you said that a lot of the debt is leases. Yeah, so leasing. So there was a change a few years ago. I think it was AASB 16. Could be wrong about that. Not up to date with my accounting standard changes. But there was a change a few years ago that basically meant that companies now had to start reporting lease liabilities alongside their debts rather than having it as a quote unquote off balance sheet item. So this is really important for people to understand because what companies could effectively do is they could hide their liabilities by, like, if you go back to the coffee machine example, right? If you go back to the coffee machine example, maybe you go down the street and you buy the cafe that's down in your main street. If you go and buy that cafe and the coffee machine is on a lease that you have to pay for the next 3 years, it's basically the same as the debt, isn't it? It's like going to Harvey Norman and getting one of those coffee machines and they say no interest for blah, 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 blah. You still need to pay for the bloody thing. It's just that it's on a contract that you haven't had to pay yet. So the accounting regulators basically forced all the companies to say, yeah, it's not a bank loan, but it's still debt. So chuck it on your balance sheet. And that's basically what's happened here. So, yeah, I know I've gone on for a while. Percy said, can't the dividend yield be manipulated if profit or a number goes down? Yes. Yeah. So one of the things that I could be wrong about with Inghams is that because of the chicken shortage, right, and because of all these things that it's done recently, because of all the stuff that's going on, basically stuff. What an elegant word. Because of all the stuff that's going on, basically the company could look cheap now, and in a couple of years, once farms are back up and running and all that sort of stuff, well, Inghams as the big provider of chicken to Australia and New Zealand, will probably win from that. It'll probably solidify its position and become more profitable and stronger. And so the thing that we could be wrong about is this cheap stock could actually be less cheap in the future just because the industry picks up, if that makes sense. So I hope that makes sense. Okay, so for me, I've got to admit, Inghams is probably a pass for now. Maybe it's something that we table again in the future for the live program. I wanted to quickly, we can, by the way, we can come back next week and continue on with more of these companies. I know that this is probably the favorite segment that we do on the live show every month. I do have to tell you though, um, we do have. It looks like he has accepted my calendar invite, but next week it looks like we're doing. We're not done yet, by the way. I just want to tell you what's happening next week on the Rask Invest live show. I think we're going to have Pete Wargent, the Honourable Pete Wargent. Where is he? There he is. We're going to have the Honourable Pete Wargent jump on the show, and we're going to do a macro update next week. And we're going to talk about interest rates. We're going to talk about everything, stock markets, property markets. That's next week on the Rask Invest live show. So this time next week, Pete's going to be joining us. But then the following week, I wanted to do a segment on the Rask Invest live show called Nightmare on Collins Street. Obviously, Collins Street being the big finance hub or big finance street in Australia. It's kind of like Wall Street for Australians. I wanted to do Nightmare on Collins Street and share some of the nightmares that happen with people get involved in investing and things go wrong. So if you have any examples that you can write into me, please let me know of things that have gone wrong, frauds, scams, Ponzi's, all of these types of things. I would love to know what you've heard, what you've experienced, what you've seen. Please write into me. Nightmare on Collins Street. I need some help with this. Tell me about some of the things that go wrong in investing. Graham, you said, would you consider Technology One and Pro Medicus, which have performed very well but look very expensive? Yeah, I mean, full disclosure, Graham, I own Pro Medicus, and I found out this week that it's gone up again. It's $179. Yeah, wild. Yeah. I mean, we added last month, Graham. We added the Rask Invest Live portfolio. We added WiseTech. Now, at the time, we kind of said that it was very expensive. And, traditionally you would do more valuation work and that sort of a thing. But we thought at the time, if I got it up in the Vexer here, we can see that we added, what was our cost base on this? I think I can click on this. And so we can see how much we bought. Oh yeah, that we put 5,046 Navexa dollars into this, right? At the time, we said it's only $5,000. We've got $1 million in our fake news portfolio. So rather than try and say, "Oh, it's overvalued," I'll wait and buy it in the future. What we instead said is, we'll buy a little bit, see how it goes, and then play out over time. If it falls, maybe we revisit and we buy more. If it keeps going up, well, at least we've got a little bit. I hope that makes sense. Graham with a H says, would Ingham's group qualify as cigar butt investing? Not something I often really look at. Yeah, I think it would. It wouldn't be true cigar butt. So the term cigar butt comes from someone that walks on the street and picks up the old cigarettes that have like the last puff in them. And the idea is that you could buy a dollar for 80 cents. But the problem is that in investing, if you try and buy a dollar for 80 cents, is that oftentimes you get the dollar part wrong. So you might buy a dollar for 80 cents, but then the dollar, or what you thought was a dollar, is actually 70 cents. And it keeps falling. That is value investing and the really difficult thing about value investing. But when originally Ben Graham in the 1920s and 1930s talked about cigar butt investing, he was talking about something called net nets, which is basically where the value of all the cash, so in this one, it was the green. He was effectively saying, because remember, this was before the internet, this was before anyone could access the stock market and company financials. He was basically saying, if a company had, say, $200 million of cash on the balance sheet, right, and it had no debts and loans, but the entire market cap of that company was only, say, 150, on the stock market. What he was saying is that the value of the cash alone, if you net it off, was worth more than the entire company. So why wouldn't you buy the shares? Even if it was a horrible business, at least you could close it down and just take the cash. And that's effectively what was happening. So that's what he was saying. So that was the traditional kind of where the traditional value investing framework came from, the idea of cigar butts and that sort of thing. Now, finally, I've got to try and squeeze in some companies here. There's a company called XRF Scientific. Now, this was brought to us, and I've followed the company for many years. XRF Scientific, what it does, very small company, price earnings ratio 25. What it actually does is it creates tools for laboratories and testing equipment. So if we go to the website, as we did last time, so if you see like a machine like this, what would happen is in a laboratory or in a testing environment for, say, like there's like a sample that's come from the ground or at a mining site, or in an industrial area where they're building and digging soil out of the ground, they want to test it, or there's a mineral that they want to test. They'll take that little bit of the mineral, put it in like a cup-like thing, like I've got in my hand here, and they'll put it into a machine, goes through like a furnace, like heats it up, and it produces a test result to determine the purity and the consistency of the sample. And so XRF makes the machines that does that. It now has a machine that crushes all the samples up to get it into like a smaller, more powdery type thing. It sells all the little consumable equipment that goes into that machine along with the actual thing that they're testing. So it does all of those different types of things. Now, I think it was Tarwin mentioned the market index website before. It's a great website. XRF is the ticker symbol. And the reason it's XRF is it stands for X-ray fluoroscopy, which is the type of test that it does. And if we go down, one of the things that's always been really appealing about the business is Mr. Vance Stancinelli. He's been with the business for such a long time, and you can click on the bio here. But if we keep going down, you can see that he owns, where is he? He owns a lot of shares indirectly. You can see that other directors own a lot of shares in this business. And that's a really, really, really good sign for me. When a company is small, growing, profitable, and pays dividends, and its directors have been there a long time, and they own a lot of shares in the company, and you can even see here on market index, they're buying a lot of shares. Brown sold some shares, but you can see he still owns a lot down the bottom here. Those are really, really good signs for me. So if we quickly bring up XRF in here, and we go in, we just look at the financials. Okay, yeah. So Taiwan, you got a great summary here. XRF provides mission-critical consumables to the mining sector, and while still a bit cyclical, less so than the actual mining companies. Absolutely. Reminds me of during a gold rush, sell the shovels. Absolutely. Yeah, Darwin, you do own shares. That's fair enough. Thank you for the disclaimer, sir. So if we look here and we now look at the profit margins of this business, this is not net profit margins. I'll be fair and go down to net profit margins into ratios here. Now we've got 15% profit margins. That's much, much better. Now we're talking my kind of language. So if we go here, you can see the profit margins have improved over time. This was where they actually kind of reinvigorated the business, and they made a few changes. They started to embark on a different strategy, and they've started moving to more consumable type businesses, business models and products and services. While this profit margin has remained steady, crucially, if I stop jumping around, Owen, if I go here and I look at total revenue, while the profit margin has remained steady, so we'll do margins, we'll do in columns, and we'll do total revenue in a line chart. Crucially, revenue has been going up, but profit margins have remained in place. That's obviously a sign of a very good business and a well-executing management team, because it's saying we're doing more business, but we're not just doing crap business. Like, we're not taking any customer. We're actually delivering more value, and we're able to keep our pricing structure. Is this an Aussie penny stock? Lol, says Matthew. Yeah, it would be the equivalent of that. And so this would be a business that is quite a risky, smaller business. It's probably not the type of one that you would have seen on the Wolf of Wall Street, because this business is an actual business that actually sells things, and it actually has a good business model, and it makes profits, and it pays dividends. But at the same time, it is a small business, so that's something to keep in mind. So yeah, profit margins higher than inflation, but yeah, I don't think Inghams was. So that's one of the things. So basically, when you see the combination of increasing sales and consistent profit margins, that means profit goes up over time. It means dividends are more sustainable. It means cash flow goes up. So all of those things start to contribute to it. Now, they don't happen. You have to have good management and all that sort of stuff to make that happen. Another thing that you can look at, and I'll be quick here, is if you go diluted shares outstanding and you look at something like this over time. I'll turn off this other one and I'll get rid of this one. So if you look at the number of shares outstanding, this tracks how many shares are available to buy for everyone. And what you can see is that it's basically flat. An option for some companies is just to give away more shares and use the money that it collects from those shares to fund its business. And its profit margins look good, its profitability as a whole looks good, but on a per share basis, because there's more shares to split the pie, it's not as good. But we can see that this is a really good sign. If we go to, what was the other metric we wanted to look at? Ratios, return on capital. Look at this return on capital, 22%. Now that is good, very good. No shares getting sold, improving return on capital. Yes, it's a bit cyclical. That's probably the big risk that people need to understand. It's also quite a difficult business to wrap your head around, X-ray fluoroscopy at least, and those types of components. But good business, one that should definitely be followed. Dean, you said, how do we share investment stories for Nightmare on Collins Street? I have one. Can you please, if it's something that is personal to you, Dean, you can jump into the Rask community and share it with me privately. So you just go up the top here and you've got direct messages. You can just send it to me. The other way would be to jump into the upcoming live shows and just put it in one of the chat comment areas just in here, just so that I can get it, or just send it via the chat widget function on the Rask website. Junie, how do we feel about companies with a great ROIC that pays a big dividend rather than reinvesting in the business? That's an interesting dynamic. So if a company has a return on capital, remember what I said before, that if a company has a return on capital of 20%, what it's effectively telling us is the company could reinvest money into the business and get a 20% return. That is what makes great companies the best investment you will ever find, is because where else can you get a 20% return on your money? Now, the reason that this company probably pays such a good dividend as well is, one, it can afford it, but two, Tunie, as you know, there's a lot of insider ownership. So the people that make decisions own shares, which is a good thing for us, but it also means that they like dividends too. So they might also want some passive income for their efforts. So I think it's okay as long as the business can fund it. With a business like ING or Inghams before, imagine if it said to investors, hey guys, we're not going to pay dividends anymore because we're going to pay back this giant pile of debt. We'll go and expand into a new industry. The board of directors would be out of a job within 10 minutes, because the fund managers would say, well, no, that's not why I bought the stock. The super funds would say, well, I got to feed all these pensioners over here. I'm not feeding them chicken. I'm feeding them dividends. And so the board of directors would be gone. Everyone would be booted out. And so they would never do it. And they would never act truly in the company's long-term interests. Whereas a company like this that is owned by the board of directors has a lot of inside ownership. It doesn't really matter what anyone else thinks. They're going to do it anyway. And so they can act in the best interest. Yeah, I hope that makes sense. Okay, so I would like to add, if everyone's in agreement, we haven't done a lot of research, all that sort of stuff. I would like to add a very small amount to this company for our fake news portfolio. We can add maybe, just a starting position. Maybe we put 2,500 of our fake dollars in there. Does everyone agree that that's okay? And what we'll do is we'll call it a day, and then next week or the week after, we'll revisit some of these companies. We'll add the gold stocks to the list, the gold ETFs, sorry, and we'll come back and we'll review some of the other positions that I promised I would get to today, but I simply haven't done that. So Graham, you've said Skase and Bond from the 1980s. That's a good one. Opus Prime, the broker collapse. That is such a big one. That's a big one. Opus Prime, Graham, as you know, the fact that it just blew up and it took people's money with it. That's why we use a HIN-based model at Rask. So everyone who invests with us owns their own ETFs and shares. Even if we blow up, we can't even, there's no way we could ever touch the money because it's not our money. And Fang, yes, Jenny, yes. Okay, so yes, agreed. We're all, okay, we're going to put 2.5 clams in this. So what we do in the Vector here is we're going to add a trade. We're going to sell some of this. So we're going to sell about $2,500 worth. So how much do I need? Because this is a very small company. So that's why I'm just trying to, now keep in mind, this is $1 million fake portfolio. So we're going to sell 50 of our fake AAA. So sell that, and then we're going to reinvest it. Boom. Sold 50. And then we're going to go back to our fake news portfolio, and we're going to add XRF Scientific. We are going to pay $1.64 or whatever is in there, and we're going to put 2,500 clams into this little thing like this, which is about $2,500. We'll say we paid $10 in brokerage, and we'll say starting position, very risky. We'll revisit. I have to say very risky because I don't want anyone to go out and buy this based on what they hear on the fake news portfolio. How are we already down? That's okay. We'll suck it up. So there we go. Make XRF is fairly liquid, says Graham. Make it 5.5. Okay, Graham, what we'll do is in 2 weeks or a week when we revisit this, what we'll do is we will come back and we will decide if we add more to it. Because I think it's a type of business that, it's a type of business that is pretty reliable. We could come back and look at it in a little while. Percy, you love Lavisa. See, Lavisa would have been the perfect idea, Percy. If when I asked about in the Rask community, that's the perfect idea to chuck in here. So if like you want us to have a look at, I'd love to look at Lavisa in the coming weeks for this program. So we can go in there. Tarwin, you said don't move the share price too much of XRF. Kylie's yes in agreement. Thank you, Kylie. Graham, so XRF looks pretty good based on the way we think about it. Yeah. So we recommended XRF many years ago in 2019. So when was that? When was 2019? I think it was 2019. Yeah, it was 2019. So hopefully our investors have still held on because it's I actually sold it to move my portfolio into ETFs. So I mean there's that. But that's just is what it is. So this has been a lot of fun. It was a bit all over the place, and I apologize that I spent so long on the prep and the kind of preamble and the Ingham stuff. But hopefully you learned something from that. And don't forget, you've got all the links in the show notes to things like if you want a better broker, join Perla. If you want to start tracking your budget, use PocketSmith. I can see it's interesting. A lot of financial planning clients are now using PocketSmith, which is exactly what I would do if I ran a financial planning business. I would try and get my clients to use PocketSmith because I think even if you're in retirement, PocketSmith is probably the best tool to manage your own cash flow. We've got free courses. You can invest with Rask. Find us online. So Graham, you said, can you put in a conditional order, say XRF $1.60? We can do that. You know what? We have, you know what, Graham? We have fake Novexa dollars. So we have full power to do whatever we want, whenever we want. We could go back in time and add, what would our portfolio have looked like if we did buy it at $1, something like that. So don't forget, next week on the show, we will have Pete on, talk about macro. We'll say goodbye to him and say, get out of here, Pete. And then we will spend 20 minutes and we'll review the next company. So, or maybe we'll look at what was it? First of all, we will look at Fang next week. Then the next week we'll do Nightmare on Collins Street. So send your stuff in via the community. any horror stories, that sort of stuff, air all the juicy details, we'll talk about it. And on the back half of that show, we'll also include another stock. So just so we can get through these companies and start adding them to the portfolio. Now, as we come to the end of the show, I just want to make sure that you all understand the fake news portfolio. The reason that we went ahead with this name is to remind everyone that it is just a fake news portfolio. We talk about Inghams, we talk about XRF. These are not recommendations. We're here to learn the skill of investing, to talk about and debate ideas in an open forum, and to help each other learn and invest as we go. So please don't act on this information. Spending 10 minutes on a company like XRF that's been around for probably 20 years is not enough research to call yourself an investor. You would go and read 5 years of annual reports. You would listen to the analyst call or the investor calls. You would go and speak to someone that uses the products, an engineer or someone like that. That's true investing. Remember, if you have a core and satellite portfolio, the beauty of it is you can build the core portfolio. It's managed, it's tax effective, it's all that stuff. And that gives you more time to only select the very best companies that you truly understand around the outside. And so if you did that, I think investing outcomes would be better. But that's clearly not what we have time to do in 1 hour every Thursday at 12. So Costco. Yes, we'll add Costco. We will. We'll put a note in there too, Percy. We'll say we've invested $1,000 in Costco for Percy. And we'll do that. Did I catch any fish? Well, some of you may know I did a podcast live from my fishing boat last week. It is not the type of fishing boat that has a bed in it for anyone that's interested. It's a fishing boat. And that's all it does. It's not fee. And I did catch a few fish. And I actually think that I got the best bite while I was on the podcast, doing the podcast with Drew, the Australian Investors Podcast. I think I got the best bite of the day at that time, and I couldn't react quick enough. So, yeah. It's one of those things. But I wanted to share with you, maybe before I go, if you're looking for something to listen to or just is go and check out this podcast. I'm just popping it in the chat right now. Go and check. It was a heck of a lot of fun. That podcast with Angus Donoghue of Investor. I think it was the first long form podcast he had done. Absolute hoot. It was really insightful. He's such an animated and interesting character. I think highly enough of this conversation. So I'll just show you what I'm talking about. It's this one here on the Rask YouTube channel. Trust me, fantastic conversation if you're interested. So go and check that out. It's on the Rask YouTube channel. All right, that's all for now. I thank you so much for rocking up this week, putting up with the turkeys and the chickens outside. I will be back next Thursday with Pete Wargent at 12. That's Eastern time here in Australia. Thank you so much. Have a wonderful week. Invest well. Let's think about those interest rate cuts that might be coming sometime in the next year. And that's it. So bye for now. Thanks again. Good to see you all.